The Fed raising rates by 25 basis points and saying economic activity is rising at a strong rate. But as trade tensions continue to rise, could the US end up losing if an all-out trade war happens? Joining us is Hatzius, chief economist at Goldman Sachs. Very good afternoon to you. Thank you for joining us.
Good to be here.
So let's take the sort of initial reaction to this rate hike, which has kind of been a little bit bearish. What's your interpretation of why the market's reacting as it has with a flattening yield curve?
I'm not sure it's really driven by anything that we heard today, because what we heard today I don't think was very different from expectations. I mean, the only sort of nuances were that the longer term neutral rate estimate edged up a little bit and they got rid of the accommodative language in the statement. But Chairman Powell made it pretty clear, I think, in the press conference that that wasn't really meant as a major signal about the monetary policy path. So, I didn't really see a lot of news, and I think if you look at what happened in the fixed income markets, it was relatively moderate. Obviously, the equity market moved up first, then down, but I don't think that's closely related to the new news on monetary policy.
So, do you think the risk at this point is for faster interest rate hikes than everyone thinks, or slower ones?
Well, our forecast remains 4 hikes this year in total, so 1 more in December, and then 4 hikes next year. So we're above the market. That's been true for quite a while. I think it's possible that it would be faster, but I think for that you'd need more of an inflation overshoot relative to the 2% target than we have in our forecast.
Is that why you're at 4 next year? Do you think inflation is going to be a bigger problem?
No, that's not the main reason. I mean, we're a little bit above the Fed projections, but I think for me the main thing is that if the economy is already below 4% on the unemployment rate and still growing above trend, so the unemployment rate's still coming down, and inflation is, somewhere close to where they wanted, maybe even a little bit above where they wanted in the longer term, I just don't see them stopping.
Slight upgrades to growth for 2018 and 2019, quite a big drop-off after that. Does that sound sensible to you?
It does. I think after that, it's a natural forecast to come back down to approximately a trend growth rate. And in fact, there's a little bit of a hint of below trend growth if you look at the path for the unemployment rate, which rises by a couple of tenths in 2021. That's all pretty sensible if you think that you're actually at or somewhat beyond full employment. And, they do have the unemployment rate below their estimate of the sustainable level. So that makes perfect sense several years out.
Trying to sketch out exactly what circumstances you think will be necessary for the Fed to go from 3, where it is now, to 4 rate hikes, which is where you think they'll be next year. They're already saying 3.5% on GDP. They already expect unemployment to remain below 4%. So what has to change to move the Fed faster?
I think just continuing to be on this path. I think if we do realize a path of continued above trend growth and inflation is somewhat above the target, I think they will ultimately get to close to 3.5% by the end of next year. I mean, remember, their own projection has almost 3.5% by the end of 2020. To me, it's a somewhat more natural expectation to actually have that last rate hike in 2019. I think it would be more surprising, I think, to not hike, say, at the December meeting and then resume hikes in 2020. Could happen, of course, but for us, the more natural forecast is that they just keep going, and then by the end of 2019, they're done.
So we haven't really seen a big economic hit from trade, as Chairman Powell confirmed. He said, though, you could see a loss of business confidence from tariffs. Do your economic forecast numbers change if we continue to not have a deal with China and instead have more escalation and more tariffs? And by when?
So our expectation is that we will probably see, some further escalation. There's already some escalation that has been basically announced for early next year with the increase in the tariff rate on the $200 billion. And we think there is, a reasonable chance, maybe a little more likely than not, that you also get additional tariffs on the remaining imports from China.
Will that slow the economy?
We don't think that it's going to be a big drag on near-term growth. I mean, there's sort of the question of what it does to, longer-term living standards, and on that we very much agree that big trade barriers over the longer term are going to be detrimental to living standards. But whether it's so much of a negative impulse in the short term, I think is more of a question. And I think Chairman Powell actually touched on some of these issues in the press conference as well. So, it is a risk, and certainly if there was a significant loss of confidence or an increase in uncertainty in the business sector that led to the delay of investment projects, that would be a risk. But as you said, so far we haven't seen it.
To what extent, just quickly, is the flatness in the yield curve a factor of foreign yields anchoring the long end of the US curve? And do you think that's about to change? A lot of people's expectations, whether it's EU, Japan, UK, expect policy to tighten coming up.
Well, I think over the next several years, that's probably going to change to some degree. So I do agree with that explanation, that foreign factors, easy monetary policy abroad, low inflation abroad, that has been a factor at the long end of the US yield curve. I think that is eventually going to change, but I don't think it's going to change quickly. If I look at the European unemployment rate or the Japanese inflation numbers, those are still quite far away from where they can ultimately be and where I think the central banks would like them to be. So I think they can still take their time. The US, I think in the US it makes sense to normalize monetary policy, but I think Europe and Japan should not be, and I think won't be, in any kind of hurry.